Hello and welcome to Compass Global Markets Weekly Update. I'm Tony Boyajian. I'm going to give you a snapshot of what's happening in global markets, in particular a comparison between the US and Australia. US economic growth is actually forecast to rise this year from 2.5% to 3% as wages and inflation pick up. Now, following the US corporate tax cuts we saw at the end of last year, couple that together with the new government budget deal, which is expected to boost US spending by $300 billion over the next 2 years, this is quite inflationary for the US economy. Company earnings are set to rise another 10% plus over the next 2 years, and the market is now anticipating 3 to 4 US rate hikes this year. Now, the US Fed is also concerned about the aggressive nature of these interest rate hikes. So on Friday, they released their semi-annual report to the US Congress, where they eased concerns about aggressive rate cuts. In other words, it looks like it's going to be gradual, it's going to be fairly well tempered and balanced. Now tonight, US Fed Chair Jerome Powell, the new Fed Chair that replaced Janet Yellen, will speak at his inaugural testimony to Congress. It'll be the first time an official comments from him regarding the direction of monetary policy in the US. Will his message be hawkish? Will it be dovish? Certainly the markets will be watching with attention tonight. Now the next big thing is in the US, we've got the US Fed's preferred measure of inflation. They call it the PCE deflator. This number is out on Thursday. Now the current annualized figure is around 1.7%. The Fed's target rate of inflation is 2%. So depending on that number on Thursday, the market could try and evaluate the propensity of rate moves this year. Now the Federal Reserve Bank in the US, their meeting schedule for this year looks like this. They'll be meeting on the 21st of March, followed by the 1st of May, the 12th of June, the 31st of July, the 25th of September, the 7th of November and the 18th of December. We expect rate hikes in March, June and September. Some market spectators are also calling December as well. We're anticipating 3 rate hikes. This will put US interest rates above Australia's, and hence that create that interest rate differential that could see the Australian dollar slide further during the course of this year. Now, in terms of Australia, last week we saw fourth quarter wage prices come out. They rose a tad, 0.6%, or up annualised around 2.1%. Yes, it's an improvement, but still quite low in terms of historical levels. Now, the RBA has cautioned that any pickup in wages growth will be slow and protracted, especially weighing on household incomes and the high levels of debt. Now, whilst Australia's jobs market seems to remain robust, it still has more spare capacity when it's compared to other developed countries. And Australia's unemployment rate needs to go back below that 5% level, head towards 4.5% before Australia can start talking about full employment, similar to the situation in the United States. Underemployment, however, remains the real issue. Underemployment is the number of people with a job but seeking to work more hours. That has absolutely ballooned over the last decade. It's increased by almost 70%. The number of people underemployed in the last decade has moved from 655,000 to over 1.1 million people. And this is the real issue for the labour market going forward, not the part-time, full-time jobs mix or the unemployment rate per se. So, in a nutshell, given Australia's outlook for a benign inflation environment, weak consumer and household spending, the market is not pricing any rate hikes in Australia until May 2019. That should keep the Australian dollar confined to the 77.5 to 79.5 cent range. Have a great week. Thanks for watching. I'm Tony Boyajian.